PayPal stock is currently down 74% from its 2021 highs. This is the largest decline in PayPal's short history as a public company by far. So, is this a busted company or is this just a busted stock? Here's why I think it's the latter, and I'm happy to buy shares today. My name is Brian Feroldi.
And my name is Brian Stoffel.
Thanks to Common Stock for sponsoring today's video. As of the time of this recording, I own shares of PayPal and Brian Stoffel does not.
So Brian, today PayPal is a $94 billion company, which is a little amazing because it used to be worth nearly $400 billion.
PayPal's mission statement is very wordy, but at its core, the company is focused on democratizing financial services to ensure that everyone can take control of their financial life. There's a lot that PayPal does, but at its core, it's a payments company. It owns several brands, including PayPal, Zoom, Venmo, Paydi, Braintree, Hyperwallet, Honey, and more.
PayPal primarily makes money off of a percentage of transactions, so it's usage-based, but it can also make extra money in terms of foreign exchange, cross-border transfers, and value-added services.
Growth in some of the company's key metrics has been lumpy given the pandemic. However, if you look at transactions, this has grown at a 25% annualized rate over the last 7 years, which is very strong.
Just as encouraging, total payment volume, which measures the amount of money changing hands through PayPal's ecosystem, has grown even faster at 28% per year, topping at over $1 trillion last year.
PayPal has gotten to the size and scale where demand for its products and services will ebb and flow with the economy. However, we think that it continues to take share in the payment space and grow even if the economy is weak.
Now, turning to the moat, we're going to recognize how powerful the size of that network is through the network effects. PayPal is by far the most commonly accepted digital wallet payment form in North America. And because of that, it engenders strong network effects where more merchants that accept mean more users who want to use it, which leads to more merchants accepting it as a form of payment.
We also think that PayPal benefits from high switching costs. Once you get set up and using PayPal, it becomes a little bit of a hassle to switch away to something else.
Beyond that, we definitely give this company credit for its brand value. People know about PayPal, and overall, we think that the moat surrounding this business is stable. Now, if we look at the overall numbers, revenue growth has been solid over the past couple of years. Gross margins are decent. Net income and free cash flow have both been plentiful, if not growing very fast. The balance sheet is strong with over $15 billion in cash and only $8 billion in debt, and returns on capital are relatively high.
PayPal is no longer run by its founders. Instead, CEO Dan Schellman has been in the corner office for more than 7 years. He gets great reviews from employees overall. However, inside ownership here is very low.
Looking at the company's opportunity, we believe that PayPal has a ton of optionality. Each one of those things you see listed there is a new product that it's rolled out over the past 10 plus years. Now, one knock against the company is that it's already largely optimized for free cash flow and profit, so there's not a ton of operating leverage ahead. However, the addressable market is enormous for digital payments. Total payment volume worldwide is expected to be about $185 trillion, of which PayPal has captured less than 1%. And while it goes after that opportunity, it does have a history of funding it through acquisition.
Despite the fact that PayPal stock is down huge, this company has still outperformed the market since being spun out of eBay more than 7 years ago. Its track record of exceeding expectations on the bottom line has been mixed in recent years, and while the company does produce huge amounts of net income and free cash flow, it uses that to reward shareholders primarily through acquisitions and buybacks.
The biggest risks for investors to keep in mind are competition, disruption, particularly from cryptocurrencies, outside forces, especially interest rates and the macro environment, and the valuation, which is still a little high but more compelling than it's ever been before.
We'll cover the valuation in just a little bit, but here's how the company performed in the most recent quarter. Revenue was up 8% to $6.48 billion. That exceeded Wall Street's estimate and exceeded management's guidance. The bottom line wasn't as pretty, with earnings per share falling 28%, but that is largely in line with what management and Wall Street was expecting.
If we dig a little deeper, we see that gross margins, operating margins, and net margins were all still relatively healthy. It's worth noting that free cash flow and net income did fall. However, that was expected as management is hitting the gas on investments and business has slowed somewhat. The balance sheet is still in excellent condition with $15 billion in cash and $8 billion in debt.
One reason why shares have been under so much selling pressure recently is that the company's growth rate has slowed dramatically. In the most recent quarter, total payment volume actually declined sequentially to just $323 billion, and the growth rate has slowed dramatically when compared to 2020 and 2021.
The number of new accounts being added has also slowed dramatically, but is still positive. But one trend we're keeping our eye on is the number of transactions per account, which reached an all time high of 47 during the most recent quarter.
Demand for the company's product and services absolutely exploded in 2020 and 2021, which artificially boosted the company's margins. More recently, we've seen the reverse of that as PayPal has continued to invest in its business and the top line growth has slowed, which has put downward pressure on its margins and profits.
Now, management has said a lot about how it's pivoting its approach right now, but why? Well, they pointed out a couple of things. One are inflationary pressures combined with supply chain issues that caused the US economy to actually contract during the first quarter of 2022.
Management noted that they have a lot of headwinds going against them right now, one of which is a return to in store shopping experiences, which is a headwind for companies like PayPal.
They also noted that as the economy has contracted and inflation has expanded, people are spending more on non discretionary items like groceries and gas, things which they don't usually use PayPal to pay for.
So, what's management going to do about it? They're really going to hone in on growing two businesses in which they excel. The first is checkout, the second is digital wallets. These are both areas where PayPal is a market leader and can continue to expand its leadership position.
At the same time, they're going to be cutting back expenses in other areas like international expansion. While they're going to leave in place their ability for merchants to use cross border commerce, PayPal won't be investing as much in that business as it's too expensive to acquire customers and they don't get enough payback.
So, taking all that together, what is management expecting for the upcoming quarter? They guided for 9% growth in revenue to $6.8 billion. That's about what Wall Street was expecting. Management expects that margins will continue to be under pressure, and they're calling for a 25% decline in earnings per share to about 86 cents. That was below what Wall Street was expecting.
And if we turn to full year guidance, we see much the same story. Management is guiding for about $28.5 billion in revenue. That'd be growth of 12%, which matches Wall Street's expectations. They also see the company earning about $3.85 per share. That's a little bit below what Wall Street was expecting and represents about 15% decline from the same time last year.
So, what does this all mean for the company's current valuation? Well, if you look at PayPal's current price to sales ratio, it's currently trading under 4 times, which is the lowest valuation on record.
The same is true if we look at the price to earnings ratio, which is useful because PayPal is optimized for profits. It's trading at about 27 times trailing earnings, which is the lowest mark since it came public.
It's a similar story for the price to free cash flow ratio. PayPal is currently trading under 20 times free cash flow, which shows just how much pessimism there is in this business today.
So, what are we going to watch moving forward? Well, first and foremost is total payment volume. The more money that flows through PayPal's ecosystem, the wider the moat is.
The second is total user growth. While it's understandable why user growth has slowed so significantly in the most recent quarter, we want to see signs in the long term that PayPal continues to attract new users to its platform.
At the same time, we want to know that existing users are using more products. So, we're going to keep an eye on all those new products that PayPal is rolling out.
And fourth, we're going to keep an eye on the company's free cash flow. Management noted that they're in investment mode right now, so we expect free cash flow to ebb and flow. Over the long term, we want to see free cash flow production continue to rise over time.
Taking all these things together, we think that PayPal is in a moment of transition, but its moat is very stable.
And while there are potential for yellow flags, we can't help but think that the overall thesis for owning PayPal stock is still largely on track, even though the company's growth rate has slowed considerably due to the pandemic. So how does this company score on our investing checklist? I knocked a couple of points off recently, but this is still very much in my investable category.
And PayPal lands right in the same range on my anti-fragile framework. It lost some points because its founders are no longer involved and management doesn't have a lot of skin in the game.
So there you have it. Overall, we think that PayPal is still a strong business and it's much stronger than its recent stock price movement would indicate. To take advantage of that, we'll be adding PayPal to our real money portfolio. So this is our fourth real money purchase. If you want to follow the portfolio in real time, you can do so by following us on Common Stock. We'll also be posting all the slides that you've seen today to our Common Stock profiles. Common Stock has agreed to give $250 cash to whoever makes the most insightful comment on our slides.
And we mean it when we say we're looking for the most insightful comments. They can be for or against or adding any color to our buy decision. We're looking for a value add.
So there you have it. We're going to be adding PayPal to our real money portfolio soon. We know that investing sucks right now and it's really hard time out there for investors, but we're going to remain focused on what we can control, which is finding good companies, buying them at compelling times, and holding for the long term. Brian's out.